A common gift tax planning technique when you're making transfers to an irrevocable trust is to give beneficiaries what are known as Crummey withdrawal rights. The whole purpose of that is to qualify the gift to a trust as a present interest so that you can apply a gift tax annual exclusion for each beneficiary who has a Crummey withdrawal right. Now, that applies to the gift tax. When it comes to the generation skipping transfer tax, the rules are a bit different. In general, non-taxable gifts are exempted from the GST tax by giving them a zero inclusion ratio. But there's specific statutory authority which disqualifies transfers in trust from this bare GST zero inclusion rule. And the mere granting of Crummey rights doesn't meet the requirements for this GST tax annual exclusion. The trust requirements to qualify for that exclusion are rarely practical, so in most cases, for irrevocable completed gift trusts that are funded with annual exclusion gifts, grantors may have to rely on the GST automatic allocation rules or file a gift tax return to manually allocate GST exemption for each year that annual exclusion gifts are made. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode, episode 205, is all about GST tax and Crummey withdrawal rights. We'll dig into the requirements of trusts that could qualify for the GST tax annual exclusion and dig into some of the implications of those rules and requirements as well. Now, as always, this presentation is not intended to substitute for legal or tax advice. It is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to the presentation. So, to set the stage for today, I don't intend for this episode to be a primer on Crummey rights or the requirements for them, but generally the stage is set in that the gift tax annual exclusion is only available for gifts of present interest, which means the beneficiary has the immediate right to enjoy the property that's been gifted. Now, most transfers to irrevocable trusts will be transfers of future interests which do not, unless it's a certain type of trust. But long ago, in 1968, there was a tax court case appealed to the Ninth Circuit, Crummey versus Commissioner, where the Crummey family created a way to achieve present interest gifts to trusts by giving beneficiaries a temporary window of time, usually 30 days, to withdraw a share of any gifts to trusts up to the annual exclusion. So, in other words, if you make a transfer to a trust, the beneficiary could withdraw up to the annual exclusion, or if less, their proportionate share of the transfer to the trust. So, if you make procedurally sound transfers within the requirements of Crummey that have been developed, you'll generally qualify for the gift tax annual exclusion, which means you don't have to worry about filing a gift tax return, you don't have to worry about using up any of your gift tax applicable credit. It's a great way to fund trusts, especially things like irrevocable life insurance trusts or ILITs, which require premium payment transfers every year. Now, there's also a GST tax annual exclusion, which isn't an annual exclusion per se. It's more set forth in Code Section 2642, which states that a direct skip, which is a non-taxable gift, will generally be given a GST inclusion ratio of 0. In other words, that transfer, if it's not a taxable gift, will also be exempt from the GST tax by virtue of that 0 inclusion ratio. But there is a caveat that says transfers and trusts don't automatically meet that rule. So simply giving a Crummey withdrawal right will not allow the use of the GST tax annual exclusion. Instead, there's specific requirements within Code Section 2642 to qualify transfers and trust for this 0 automatic inclusion ratio that's pegged to a non-taxable gift. So in order to do so, in order to use this GST tax quote-unquote annual exclusion, For one, during the beneficiary's lifetime, the beneficiary must be the sole permissible distributee of both income and principal of the trust. So in other words, you have to have a share just for that beneficiary that's completely siloed. They're the only beneficiary of that $15,000 annual exclusion gift, or $30,000 annual exclusion gift if there's gift splitting. And not only that, this is the real kicker, which kind of makes this impractical. At the beneficiary's death, if the trust does not terminate prior to their death, then the assets of that siloed trust must be included in their gross estate. So each and every one of these $15,000 annual exclusion gifts has to go into a silo just for that beneficiary, and the sum total of those plus any growth in each of those over the years has to be included in the beneficiary's gross estate at their death. So how do you do this? Well, like I said, you silo separate shares for each individual beneficiary, and in order to meet that gross estate inclusion requirement, you have to give each beneficiary a testamentary general power of appointment. Now, Crummey rights are usually rights that you want to lapse at least to the extent of $5,000 or 5% of the trust property to which the right applies every single year. And that's a subject for another time. So in order to meet this GST tax annual exclusion requirement for transfers and trust, it means your Crummey rights can never lapse. So they have to be outstanding, and essentially the beneficiary has the right at any time to withdraw their share of any transfers and trusts, which kind of defeats the purpose if, for example, you're trying to fund an irrevocable life insurance trust. Now, even if the GST tax annual exclusion is used, the beneficiary's death will result in a wiping of the slate because the assets of that silo will be included in the beneficiary's gross estate. So at that time, it doesn't matter that you had a GST exempt trust through all these annual exclusions. Instead, the beneficiary then has to still allocate their own GST tax exemption to that siloed trust. So as you can see, this is completely impractical for most irrevocable trusts that you would fund with annual exclusion gifts. So you may have to use GST tax exemption for annual exclusion gifts in trust. So there's a couple ways we can do this. One is we can rely on the automatic allocation rules, which essentially means that for every dollar of gift tax annual exclusion that you use, that dollar amount of your GST exemption will be automatically allocated to the trust. Now, if you didn't want to have every dollar automatically allocated, you could also elect out of the automatic allocation rules and instead manually allocate, which now requires you to file a federal gift tax return, Form 709, which you otherwise would not have had to do prior to this for just the gift tax annual exclusion. And with that, you'd have to elect out of automatic allocation of GST exemption and manually allocate it to maybe direct skips to skip persons who are beneficiaries and look at how manual allocation would be most tax efficient within the trust itself. So that's a huge headache. So because of that, it's no surprise that few practitioners or grantors track the GST automatic allocation or even engage in the annual exercise of manually allocating through a 709. So because of this, trustees are often left to piece this information together for trusts that have been funded with annual exclusion gifts, especially trusts like an ILET. And executors down the road, when filing a federal estate tax return, may have to go back and piece this information together as well to have an accurate representation of the decedent's remaining GST tax exemption. Now, that may not be a big deal right now with a very high exemption of $11.7 million, but if legislative changes knock that back down to $3.5 million or a $1 million lifetime exemption, you can bet this is going to become a much bigger deal. Now, one of the catches to this is that if you try to make a late lifetime manual allocation of GST tax exemption, if you try to go back and get this corrected, you may have to use the value of the property at the time of the allocation. So it means you're going to be allocating more GST exemption than you would have if you just relied on the automatic allocation rules or manually allocated GST tax exemption at the time. So if you're late, it may just be better to let sleeping dogs lie and rely on the automatic allocation rules for the GST exemption. So lots of headaches when it comes to annual exclusion gifts, but it's important to make sure that the right procedures are followed. As always, if you have non-client related questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.